What's up everyone, it's Connie with MoneyVest. So in this video, we are going to be talking about the PPI numbers that came out earlier today. So there was another inflation report scheduled for earlier today at around 8:30 a.m. Eastern. So we're going to cover those numbers, and I'll also break down why this one potential metric is going to be somewhat troublesome for the markets, considering that it is now starting to move higher. So hope you all are doing great, and definitely do drop a like on this video and subscribe to the channel if you're just joining us for the first time. And I definitely do want to mention that the moneyvest.com platform is going to be releasing soon, so all of our members are going to have early access for all of the moneyvest.com benefits, including all the features. Now, there are different phases for the platform, for the software. We're going to do it over time, and the first time it's only going to be phase 1 and phase 3 of all the 6 phases that we have planned out. That's going to be available, and then over time we're going to make more and more upgrades and more features available, and of course gather more feedback from all of you, because this is a very, very big project. I mean, think of it as building something very similar to TradingView, but of course we're not nowhere near close to the size and scale of TradingView. TradingView, of course, has a significant amount of dev, and a tech on the back end that they are working on. But eventually, the plan is to get to that level. But right now, we're going to start small, start slow. So again, if you want to get access, early access, because at the end of the day, I really want to build something that is going to be helpful for all retail investors out there, because there's a lot of things that retail investors like you and I have always wanted access to, but were never given, right? Because of how concentrated this entire industry is when it comes to fintech platforms and just financial analysis software. There's very little that investors have access to and can do with the data that's out there. So I want to really give the power back to retail audience, retail traders, so that you can play around with the numbers. You can actually calculate intrinsic value, put out your own analyst estimates if you have, because everyone at the end of the day is an analyst to begin with. So again, link's going to be down below. We'd love to have you on board, and we'll definitely appreciate your feedback on the platform. So we're going to come back to this analysis here, because this is basically the S&P 500 metric with respect to the earnings per share and where we are on a price to earnings basis. But this right here is the PPI numbers. So this is where the producer price index sits. So 0.6% month over month is where we ended up at, around 0.3% consensus and 0.3% consensus. We came in twice as much as the consensus expectations. Year over year, we're sitting at 1.6%. And that, again, is much higher than the 0.9% and 1.2% consensus. So these numbers actually came in a little bit hotter than what the expectations were, especially core inflation. If you take a look at ex-food, energy, and trade services, we came in at 2.8% versus 2.6%, which is the prior number. And ex-food and energy also increased 0.3%, hotter than what the expectations were. And core inflation sits at 2% as well. These are the jobless claims numbers, which again came in at 209,000 compared to the consensus of 215, and the prior number was around 210. So it's been still relatively low compared to what we have seen during times of recession. So again, the labor market, the unemployment numbers continue to be very, very strong, although we did see a little bit of an uptick from 3.7 to 3.9%, approaching that 4% level. But nonetheless, we are still very good on the unemployment numbers here. Now, going over to the markets. Now, this right here is the troubling part. We've got the 10-year Treasury yield pushing back higher. Now, it is up a little bit over 2%, so almost at 4.3% is the current 10-year Treasury yield in the United States. Now, this number is always and should always be compared against the S&P 500 earnings yield, dividend yield, and just to calculate the risk premium. And the risk premium is essentially what premium are you getting, what is the above and beyond return you're expected to make for taking on that additional risk. And the reason why we calculated against using the 10-year treasuries is because this is called a risk-free rate, right? Because it's considered risk-free because the United States is one of the strongest economies in the world, and because of the fact that the U.S. has never defaulted on its debt. The idea is that 4.2, 4.3% annually is kind of guaranteed, right? Again, nothing is guaranteed in the market, but this is almost guaranteed because, again, we're talking about the United States and their debt, and they've always repaid the interest, at least, on their debt. May not have paid all the debt itself, because we're kind of mounting to over $30 trillion, but at the same time, it's considered risk-free because it's backed by the U.S. government. And 4.284%, if you come back to our spreadsheet now, if you take a look at where the earnings yield on the S&P 500 is, it's at closer to 4.36%, considering that we are at around 23 times earnings multiple. So this is always, a good metric, a good gauge to better understand how much more upside the markets really have. And again, from a risk-adjusted basis, whether it actually makes sense for us to be looking at the markets or for us to be looking at equities or fixed income. Because I can tell you that from a risk-adjusted basis, the bond market is starting to look very attractive once again, because we have come back in from low 4 percentage points to back over 4.286%. And you have no idea how important those 26, 27 basis points can be over a lifespan of the entire maturity of this bond over 10 years when you are investing hundreds of billions, if not trillions of dollars. So that, of course, can make a significant impact over longer time frames when it compounds over the years. So, very, very important level to keep in mind is, of course, that 4.3.5%. That's exactly where we were back in February 22nd, February 21st. And that, again, the higher the yields go, the more impact they're going to have on growth stocks, on technology stocks. And right now on the day, you'll notice that Tesla, once again, dropping heavily down about 2.7% to 164. We've got NVIDIA down almost 3%. AMD's down about almost 1%. But Microsoft and Google with a very nice recovery, Apple with a very nice recovery. And again, these were both part of our trade ideas in our newsletter. So I mentioned this in our newsletter with specific targets and specific price levels. Google here pushing higher also very, very nicely. And again, we talked about this over the weekend also and in our newsletter that I published earlier in the week. So if you want access to all of that, link's going to be down below. I promise I'm only going to be bringing higher quality opportunities, high quality setups for all of you and not anything else. So this is where we are again, technology. Overall, broadly speaking, the markets are somewhat stable even on the day today. So NASDAQ's basically flat. S&P 500 is basically down about 22 basis points. But the idea here is that inflation is, in my opinion, somewhat here to stay. That is to say that inflation is taking a very, very long time coming down to the Fed's target of 2.5%. 2.2%. And right now we're still way too elevated compared to where the Federal Reserve wants inflation to be. And if that is the case, the probability for us to see interest rate cuts only diminishes over time if inflation continues to be elevated and more or less stagnant. I also broke down 4 different scenarios in the newsletter. So 4 different scenarios from a macro perspective based on where unemployment and inflation is going and how the interest rate policies could get affected. So if you want to read, again, there's a 6 to 7 page newsletter that I shared with all the members. You can read that in our Discord. I published it in our private channel. Again, link's going to be down below. But S&P 500 really having a hard time somewhat seeing that more momentum. We're kind of going through these days where one of them is green, then red, then green, then red, and we're basically just going sideways at the moment. So really there's a little bit of that exhaustion in terms of that buying momentum here in the markets, and same thing with the NASDAQ where we're just really trading sideways at the moment. So if you come over to the 30-minute time frame, you'll notice we have seen a lot of consolidation since, I would say, February 23rd. So in the last 2 to 3 weeks, we haven't really seen the markets go anywhere. I mean, this right here has been the range within which the NASDAQ's been trading, and S&P 500, you could also argue, has been mostly trading sideways since the beginning of March. So we've really just been consolidating sideways in that range as opposed to kind of hitting new highs and pushing higher. So this is a clear sign of buyers' exhaustion here. Even Tom Lee mentioned that today's rally or CPI rally was on the back of lots of cash kind of sitting on the sidelines and getting deployed here. But at some point, we have to kind of understand that on a risk-adjusted basis, the market valuation here is somewhat unfavorable, not that attractive compared to the fixed income market. And with that being said, one of those 2 things need to happen. Either the bond market needs to once again rotate back lower, the yields need to drop, or equities need to drop. One of those 2 things need to happen in order for equities in general to become more attractive once again on a valuation on a price earnings basis. But until then, of course, individual stocks definitely will have their appeal for future returns, but of course at the right prices. You just cannot be buying at any prices because that is just a recipe for disaster in my opinion. So just be aware of where these stocks are fairly valued, where they're undervalued, where they're overvalued and stuff like that, and where the technicals are not that favorable. But right now, of course, Microsoft kind of still trading in that range, pushing higher very, very nicely. Actually, in fact, breaking out to new all-time highs here, 427 market cap now sitting well over 300, actually $3.17 trillion with a very nice breakout. Google, of course, we already covered, very nice recovery back up. My target's back up to 155. Apple also pushing higher very nicely, targets almost up to $200, and Amazon also breaking out to almost $180. Amazon, I do like very much. One of my most optimistic positions for the long term. So hope you all enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below for PPI, and what do you expect from the markets, from interest rates more specifically moving forward. And as always, make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. We'd love to have you on board, and again, access to all the newsletters, the moneyvest.com website, including all the trade ideas and alerts. So links going to be down below with that 16% annual discount. As always, happy investing. I'll see you all in the next video.